All right. Good morning, everyone. I'm Mick O'Brien. I'm the Managing Director of EQT Holdings Limited. I'm here with Philip Gentry, our Chief Financial Officer and Chief Operating Officer. Welcome to this call. We're going to take you through the results for the company to 30 June 2020. So the agenda for this morning, I'm going to talk about how the company has gone through 2020. Philip's going to walk you through all of the financials. And then I'll come back and talk about the strategy update and an outlook for the company. You can use the Q&A facility on the screen to ask questions, but we'll answer the questions when we get to the end of the presentation. So let me give you an overview of the 2020 year. I guess the first thing to note is that result was a really strong growth in funds under our management and supervision, against a very challenging environment just generally in Australia and for financial services particularly. So our funds under management, administration and supervision were up 19% to $101 billion. So we were just above $100 billion at the half year, but with the market downturn went below and then back up above $100 billion. There's been a substantial investment in our capability that's been underpinning this success and this growth. There's been very noticeable new wins that we've announced to the market, particularly in recent times, and those opportunities give us more momentum for growth in FY21. We really are capitalising on the industry trend to outsource the fiduciary role and for other companies to focus on their core capabilities. And we continue to believe we're really fulfilling our purpose as a trusted specialist fiduciary, both for our clients and what we can do for the community. I'll just take you through the highlights of the numbers. Revenue was up 3.2%, so that's notwithstanding the equity market downfall, which was obviously very severe and lasted through the last 4 months of the year. Our net profit before tax was $30.3 million compared to $31.3 million in the prior year. Net profit after tax was $19.2 million. Importantly, that includes a provision that we've made for a long-standing tax matter, and Philip will cover that in more detail in his presentation. Our underlying earnings per share was 5.5% lower to 102.7 cents. The board have chosen to pay a final dividend of 43 cents, which brings the total dividend for the year to 90 cents. So that's the same as it was in FY19. And again, through these results, you'll see that all the businesses have been performing well and exhibiting good growth. Funds under management and supervision really is the number one driver of the revenue of the company. So we focus on this number, quite considerably. And you can see there the 19% increase on the prior year to come in at $101 billion. So there were $19 billion of new appointments that we made in our superannuation and our corporate trust area, corporate trustee services area. Most of those happened in the first half of the year, and we'd already said that we'd quantified the increase in annualised revenue for those appointments at $2.5 million in their first year. We'll talk more about how the other appointments look a little later in the presentation, but that is really, very significant growth. The key financial measures, just walking through those, I mentioned the revenue before, up 3.2% to just over $95 million. Net profit after tax, if we look at the underlying numbers, $21.2 million. And as I mentioned before, with the tax provision at 19.2. Looking at EPS, we've come in at 102.7%. So you can see the progression of that over the last 3 years has been very strong and consistent. And I should say there's been no real increase in gearing producing that result over that time period at all. And as I mentioned before, the dividend has been maintained for the full year at 90 cents, which is, we think, great reward for shareholders, and, sets us apart from many financial services companies that have come under pressure of late. Now, this is an important slide because it shows you the funds under management and supervision in both TWS and CTS. And I'll first start with TWS, the significant growth there to 19.3 million. I've also put in there two green shaded blocks that show 2 new appointments that we've announced post the balance date. So being the appointment as a superannuation trustee to AMP Life and also to Hub24. So we're delighted that those companies have chosen to partner with us and looking forward to servicing them and all of their members and investors in coming years. But with that, it brings our total superannuation business to some $26 billion of assets. This was a business that was only at $2 billion 4 years ago. So we've experienced extraordinary growth there, and we're now looking after 750,000 members in the superannuation business. On the corporate trustee services side, again, very strong growth, and primarily off the back of 2 major appointments, one to AIA earlier in the year and the other to River and Mercantile in the United Kingdom. So it's a 19% growth in the funds that we're supervising in corporate trustee services. So I think what this slide shows is there is great demand for the independent fiduciary service for fund governance, both for investment products and for superannuation products. I've touched on a couple of these things, but just expand on why this is happening. I think the Royal Commission of a couple of years ago indicated financial services companies were looking to, I guess, improve and upgrade their governance for their investment schemes and their superannuation funds, and that really has been our core capability. That has driven a lot of the change, as well as some of the divestments that diversified financial services companies have been making. And when those divestments have occurred, people have reconsidered their operating models and considered our independent trustee proposition. I've talked through those appointments in superannuation on the previous slide, and also on the corporate trustee services side. I'll just mention one other thing, and that was the appointment to our 3rd listed investment trust for Partners Group at just over $500 million that was earlier in the year. Now, these are very large scale appointments, the ones that happened in FY20 as well as in the last month to AMP Life and Hub. And we've sized up for you there the collective additional revenue that we expect in FY21 of $5 to $6 million from those appointments. Now, we've been positioning for this growth. We certainly flagged it to the market 6 months ago and 12 months ago that we would continue investing in our people and our technology because we did expect this type of growth. We've continued emphasising our governance and risk management, so it's absolutely core to what we do and why people appoint us into these roles. I'm going to come back to talk about some of the key board appointments and executive appointments later in the presentation. And we remain active looking at M&A opportunities. We expanded our business into Ireland out of the UK at the start of the financial year. So we've got a direct licence with the Central Bank of Ireland and established office in Dublin. And I think we're very well positioned for future opportunities the way we stand at the moment. Now, we've talked to the market before about our T4 measures. This is what drives our focus internally to make sure that we are delivering to all of our stakeholders. I think it's held us in good stead, particularly in these times that we have got to focus on all of our stakeholders, our clients, that's our purpose for being, our employees, which is really the key to our success, obviously shareholder support and growing the value for shareholders, and this unique position we have in being able to make an enormous impact on the community through our philanthropic granting. I'm just going to walk through each of those, first, starting with client satisfaction. We serve our clients every year, and these 2 scores indicate the likelihood of clients recommending equity trustees to other people and utilising our other services and products. And had a really significant uplift on both those measures in the course of the year. We extended this survey this year to our superannuation members as well as Indigenous community members of our trusts, and I'm really delighted with those results. This is a multi-year journey for us, but we're going to keep investing in our digital processes, and also we've had a major uplift in our client communication through the course of the year. I think that's been important in these very challenging times. If I move on to employee engagement, people are key to our success. We survey our employees each year. This year we did it in June, so it's at the height of the lockdown, and I just remind people about 220 of our people are situated in Melbourne, 220 of our 250, so primarily Melbourne based, and been working remotely since March. These results compare to the industry, which is the industry data pre the lockdown. So we're really happy that we're above the norm on enablement and at the financial services norm on employee engagement. And our focus here is on competitive benefits for our people, training them to be the best they can, our work structures and processes, and the resourcing of our different areas. I talked before about growing shareholder value, and there you can see on the left-hand side earnings per share, which is the primary measure we're using to measure our success. And I mentioned before the board determining to maintain the dividend for FY20 at 9.90 cents. And finally, in these T4 targets, deepening our community impact. On the left-hand side, you can see the granting, the extraordinary granting that we do into the community. We have a team of 18 people that are responsible for doing this work. I guess it's been more important than ever. You can see on the pie graph there, the major amount of this granting going to medical research and the like. That's been very important through the course of this year. I'll talk more about that in a sec. We've dedicated 1,200 hours of pro bono service from some of our most senior people to establish the Bushfire Trust that we established in February of this year, and 40 volunteering days through the course of the year. So I might stop there and hand over to Philip to talk you through the financials.
Thank you, Mick. Let me now take you through the financials in a bit more detail. Firstly, just turning to the P&L. There we go. And perhaps if we just step through this P&L from top to bottom, you can see the revenue growth there of about 3.2%, which is pretty good given the impact from markets, particularly in the second half. Pared that back somewhat. You can see the expenses, the operating expenses there, 4.1% growth, reasonably well contained given there was a fair bit of investment in the superannuation business in particular, and as part of that there was a fair bit of cost containment everywhere else. You can see the net profit before tax line down slightly from 31.3 to 30.3. And of note here, you can see there's a much higher effective tax rate. Mick talked earlier on about the tax provision we've made. This is in relation to the contingent liability we've had in the accounts for a couple of years now. Relates to an acquisition that the group made 10 years ago now in FY 2011, and the provisions for around the $2 million mark. So the effect of that is the net profit after tax is down about 13%. 19.2 million, although on an underlying basis is quite a bit stronger. You can see the EPS on both bases here, down 14% on a statutory level, then down the bottom of the chart there on an underlying basis, it's only down 5.5% when you exclude that tax provision. Now moving to the half-on-half performance, just to give you a bit more flavour here. And as you can expect, the second half was somewhat slower than the first half, reflecting in particular the impact of equity market volatility from the COVID-19 pandemic, particularly through March and April. On the expense front, expenses are actually slightly lower in the second half, notwithstanding the increased investment. That reflects the cost containment in other areas. There's also some seasonality in our revenues, and that's reflected in the slightly softer second half in the TWS business as well. The lower interest rate environment also impacted some of the earnings in our cash management trust. Let's now take a look at the revenue for the group in a bit more detail. So on this bridge here, you can see if we strip out some of the one-offs, fund closure fees and the client exit from a fund consolidation, which we previously announced in prior results, the equity market impact on FUMAS, and unsurprisingly, that's hurt us a little, and I'll show you the difference between CTS and TWS shortly. But actually, the organic growth was pretty good at underlying 3.7%. We achieved growth and revenue in all of our key businesses. Let's now see how that's reflected in the cash flow. You first look at the left-hand bar here, 54.4 million of cash and cash equivalents, and then on the right-hand side you can see a very significant increase by about 30-odd million improvement in liquidity and cash equivalents here. We continue to have pretty strong cash flow generated from operations. There was some additional borrowings to improve liquidity and also to assist with some of these new superannuation appointments where we're funding some of the operational risk financial reserve I'll talk a little bit more about that shortly. Let's now look at TWS in a bit more detail. In this bridge here, you can see the equity market impact on the TWS business. Unsurprisingly, the ASX 200 was well down through March, April, and still not back to its highs. So that had a reasonably significant impact on the business. But underlying organic growth, again, is pretty strong. On the right-hand side, you can see the increase in FUMAS, principally driven by the appointment to the CMLA superannuation trustee appointment. And looking in a bit more detail at some of the TWS sub-businesses. And here you can see some of those, both on the left-hand side, some of the more traditional trustee services, and on the right-hand side, some of our newer markets. You can see there that there's a fair bit of good growth in pipeline activity, but the impact of markets is also clear. And on the right-hand side, some good momentum emerging in these new markets, which we're building quite significantly, particularly compensation trusts, Indigenous trusts, and living donors. Turning now to superannuation in a bit more detail. Here you can see the pretty significant rise in funds under supervision on the left, and likewise the increase in members on the right. The two green bars are the post-balance date appointments of AMP Life and Hub24 respectively, which help underpin the growth in FY21 for this business in particular as we look ahead. Now to CTS. Again, the bridge on the left is showing the splitting out some of the one-offs and the equity market impact. The equity market impact from the World MSCI is actually slightly positive. It's been quite volatile during the year, but you'll be aware it's come back a lot in recent months. It's actually slightly positive. Nonetheless, some pretty good organic growth, and particularly from UK and Ireland, and also from our corporate trust and securitisation business. But all parts of the CTS business had growth over the last year. Again, you can see the improvement in funds under supervision on the right. Let's now look a bit more closer at corporate trust. This is one of our newer businesses, still coming off a low base, but you can see on the left-hand side some pretty healthy revenue growth. On the right-hand side, a significant improvement in funds under supervision. This business is a healthy pipeline, and we expect to see further improvements in the period ahead. Now let's just have an update on the UK and Ireland. You'll recall we established this business a couple of years ago now, Ireland some 18 months ago, and you can see we're starting to get some real momentum there in terms of clients, funds, and assets under management. A couple of highlights there are the River and Mercantile appointment, which was about 3.9 billion Australian, and the Alliance Bernstein appointments, which are starting to generate some momentum for this business. And there's a healthy pipeline of opportunities for the year ahead. Let's now turn to the balance sheet. Perhaps on the top line, the cash and liquid investments, I've touched on this earlier. You can see quite a strong increase there, reflecting partially a desire to improve the liquidity, make sure the balance sheet's rock solid, and also to support the superannuation appointments I referred to before. The debt increased from 12 to 29 million dollars over the year, reflects some part borrowings to improve liquidity and also to capitalise our superannuation entity, which supports the appointment of CMLA with some operational risk reserve funding. Now this funding is cash backed, and Equity Trustees effectively doesn't bear the burden of the interest on that. It's effectively cash flow neutral. So it's carved out of our financial covenants in relation to our core banking facility. You can see the balance sheet remains in very good shape. Let's look at capital in a bit more detail now. I've referred earlier in previous presentations to the potential to release 2 or 3 million of capital from the consolidation of the OneView RE acquisition licence. That's now been completed, and that capital has been released. There is some further potential from further consolidation of licences in the next 12 months. And you can see we still have plenty of flexibility under our core borrowing facility of 40 million, which is currently drawn to 20 million today. So in summary, the capital position is strong. Now just providing a brief summary overall. We've had very good FUMAS growth in what's characterised as a more challenging environment. Good organic revenue growth despite the market downturn. Underlying EPS and NPAT are marginally down, reflecting the adverse markets in the second half. We're still investing in the business to create a foundation for more sustainable future growth, particularly in super. And that's evidenced by the successful appointments to AMP Life and Hub24. Our balance sheet's strong. We've got the capacity to support our growth plans, continuing to deliver for all our stakeholders. So I'll pass you back to Mick to talk through the strategy and the outlook in more detail.
Thanks very much, Philip. Well, let me talk to you about the strategy and the outlook for the company. Firstly, our vision hasn't changed. It's simple and it's clear, and that's to be Australia's leading trustee company. We never lose sight of this purpose, and it's probably been more important than ever in this challenging year. We've supported our clients as best we can through these times, and we'll continue to do so. So we're looking for all opportunities where we can deliver on their needs. And that goes also on our philanthropy side, where we've changed some of our granting and pivoted to more immediate needs for that sector, which has been very hard hit in recent months. I think clearly the strategy is working and we don't intend to change it. So representing the interests of clients and beneficiaries first, it's our core business, and we're increasingly being able to market that to other players who can focus in their core businesses and leave the governance and the aspects of protecting investors and members to specialists. The industry upheaval is also working in our favour because it put an increased focus on independence, I think the strategy is proving to be working and has been very resilient throughout this period. Just a bit of a look at the industry as a whole. The industry is going through massive change with many of the companies being divested from the banks and other big wealth groups. Technology playing an increasing part. The intense focus of the regulators, both APRA and ASIC, is causing many organisations to rethink the way they go about their business. And I think Equity Trustees is really well positioned in terms of that outsourcing of governance that is happening on the investment side as well as the superannuation side. And the reality is most of the assets in Australia in superannuation and investments are run in an in-house type of model. So we see plenty of opportunity as the industry develops. And also, we've just talked about Australia, but of course the markets in the UK and Europe are considerably larger than in Australia. And, so we've built a good start for the business there and are starting to secure some very blue chip type of clients will increase our reputation in those markets. Key for us is our people, and this is a people business that's technology enabled. And we've put a lot of investment into recruiting people in the superannuation area as that has grown, in our asset management area, and that is absolutely delivering results for us, and also in the UK and Ireland as we've been building those businesses. And I'm pleased to say, we really are being regarded as an employer of choice. So we've been able to find the key people that we've needed when we've needed them, which has been great. Technology is very important as the business scales in size, and we've just established what we see as a long-term 3 to 5 year technology plan that will bring all parts of the business up to the standard that will really deliver on the client service that we're seeking to provide to our clients. So I slipped back on a page there. And as Philip talked to you before, the financial capacity of the organisation is really strong. We've continued to manage expenses really well. So I think we have a lean business, but it has the ability to grow, and we're recruiting and putting the people on where we need to. And the balance sheet is in a really strong position that gives us flexibility should we need it and opportunities arise. Let me just talk briefly about the technology focus for the next year or 2 years. Obviously, we need to more effort into cyber security, and the team are well and truly on top of that. And I'm pleased to say we've had a pretty clean year in FY21. The government's new superannuation early release scheme has put some risk into the system, but I think we're on top of that now, and we're from the start, but it just changed the processes. So we've got to be aware of those things, obviously, for the whole business. We're increasingly digitising all of the business. I've talked before about what we've done with the Will Bank and using data analytics in there increasingly. Many of our new platforms are software as a service type platforms, and we're planning to upgrade what we're doing in enterprise risk, in human resources and the finance functions. And I guess one of the major developments is ensuring that we've got the right client portals for our business-to-business clients and our straight-to-client service. So clients can increasingly self-serve, and the source of all data and information is in one spot for those clients. So it's a reasonable investment that we're going to be putting in FY21, but it's focused on enriching the client experience and improving our efficiency, which will enhance our value creation. Now, my favourite slide, the people in this business. And I'm going to start on the left-hand side with the areas of governance. And you may have noticed in our announcement that our chairman, Jeff Kennett, has announced that he'll be stepping down at the AGM, conclusion of the AGM in October, after 12 years of service and 3 years as the chair of the company. And also Alice Williams, our longest-serving director, will also be stepping down at the conclusion of the AGM in October. Needless to say, after 12 and 13 years of service, has been an incredible contribution by both of those directors to this company. And I personally want to thank them both for their guidance and advice and support that they've given over the time that I've been here. I'm pleased to announce, and we put in the announcement this morning, Jeff announced that the board has resolved to appoint Carol Schwartz as the next chairman of the company. Carol joined our board in just earlier this year. She has an incredible CV that is so fit for purpose for this organisation. She'll have obviously a different style to Jeff, but her areas of experience are going to be an enormous contribution to the company, and I'm really looking forward to working with Carol as the chair of the company. Catherine Robson joined our board in February of this year. Catherine had been serving on our superannuation subsidiary board and been overseeing the growth in that business for the previous 6 years. So she's well known to us and already making an incredible contribution on the holding company board. We brought on 2 new appointments to our superannuation board. Paul Rogan, who has a really diverse experience in financial services and gives us just a different dimension in that superannuation space. And just recently, George Zielinski has joined us. George was previously the Chief Investment Officer at the Rest Superannuation Fund, so it brings enormous investment capability to the board. We'll put a new chairman in place into our Irish company, Deidre O'Reilly. You might have picked she was from the Irish company. And Vincent Kamalik has joined us. He's a very experienced European funds manager, joined us on our UK board, where we do need to have independence on those licensed subsidiary boards. A new company secretary, Jennifer Curry, and Tina Wee has joined as deputy company secretary. So really strengthen the governance. And look, on the right-hand side, I won't go through all of these roles, but we've needed to recruit some very senior experienced people into the superannuation trustee office, and we've been able to do that with the head of transformation, senior client account managers, and a new superannuation lawyer. We put a very important role into place in head of business development for trustee wealth services. And of course, in the UK and Ireland, we've continued putting people on in operations, compliance, and portfolio risk. So we have, I guess, been increasingly viewed as an employer of choice, and people are critical to the success of our business and looking after our clients. I'll just touch on risk for time, and we feel we have a really solid risk culture, and you can see it there in the survey results that we've achieved when we survey all of our employees and their focus on risk. We've managed to, touch wood, avoid any of the issues that have been prevalent in the industry in recent years. Our number one risk issue at the moment is looking after the health and safety of our employees. I'm pleased that none of our employees so far have contracted the COVID virus. And our focus going forward, particularly for people in Melbourne who have been locked down for a longer period and will probably most likely continue to be, is to look after their mental health as well as their physical well-being. And so we're doing everything we can to ensure that that happens. Obviously, when the market downturned in March, it's a very significant downturn, more than 30% in both Australian and global equities. that causes a lot of workload for a responsible entity, a superannuation trustee, and just for a trustee of trust generally. So our focus was on liquidity. It was on valuations, fair valuations, ensuring equitable treatment of all investors, members and beneficiaries through those trusts, and continue with very transparent communication as to how we were looking at the assets and the spreads on unit prices and the like to ensure we did produce that equity for our unit holders. And glad that we've come through that period, very strongly. Just move on to the focus for Trustee Wealth Services. There's a lot on this slide, so I'm just going to cherry pick a couple of key points. On the philanthropy side, we obviously have a great team there leading the market in ensuring that our philanthropy makes the biggest impact it can on the community. They pivoted through this crisis to ensure that the not-for-profit sector was really well supported, and really proud of the work that they've been able to do over that period. We published our second giving review in February of this year, and it really showcases the impact that we're trying to make on the community. On estate management, we rolled out a new platform through the course of the year. It's really important to deliver a great service to the beneficiaries of estates because it's the first interaction they have with our company, that has really improved the way our clients have rated us in estate management. In trust management, our focus has been growing the Indigenous trust area and also in compensatory trusts and also other specialist trusts in TWS. And it's been a good year in the past year, and our focus will continue to be on improving the client experience for those beneficiaries. Funds management, as you know, we put in place a new team headed by Darren Thompson and Chris Haynes 18 months ago. They've delivered excellent investment performance through FY20 and have really set the team up for success going forward to be able to deliver performance above market performance. So Australian equity market performance was 2% up on benchmark through the course of the year, and fixed income, so 40 basis points up. And in this low interest rate environment and volatile markets, every percent of return is so important to our clients. On the estate planning side, we've rolled out a new digital platform on the website that effectively collects our data. Our focus is on complex estates in estate planning. There's perhaps never been more need for that than what we've seen over the last 4 or 5 months, that people have focused on that. The team have been doing a great job in terms of in difficult circumstances getting to clients that are going through important estate planning discussions. Our advice business continues to be rated really strongly by our clients. So TWS has a lot on, but has had a really good year in FY20 as well, set up for FY21. We've talked quite a bit about superannuation, but there continues to be a strong pipeline of opportunities as different financial services providers focus on their core and also look to address the vertical integration and potential conflicts of interest that are embedded in many models. And we've been, well set to do that. Clearly, these are complex types of arrangements. They take a long time to come to a final appointment, but we've got the team and capability that's proven to be able to do that in very large scale appointments. Now, look, I just want to stop here. Obviously, Australia's gone through a really difficult time, with the bushfires and then, of course, the COVID pandemic of late. We set up 2 dedicated trusts following the bushfires, had them both listed in the Tax Act in record time. One set up to look after the families of the fallen volunteers. That's the Australian Volunteer Support Trust, and the other, the Community Rebuilding Trust. We've raised more than $10 million in those trusts with the help of the Business Council of Australia, and we're putting that funding out to the community already. Jeff is chairing the Volunteer Support Trust. He's so passionate about looking after those families, and Sir Peter Cosgrove is chairing our Community Rebuilding Trust for us. So, and as I said before, we pivoted our philanthropic branding to the areas that are most needed at the moment in terms of medical research and health supplies and mental health initiatives. And so pleased that the team have been able to switch focus to really meet the need of the community. Indigenous trusts is an area of increasing importance to us. We picked up 2 new trusts through the course of the year, one in Western Australia and one in Queensland, our first client in Queensland. Our goal here is to contribute to the social and economic parity for our first Australians. And we believe a trustee can play a really important role in protecting Indigenous communities' wealth and ensuring it's distributed in the best way possible, and empowering those communities to take control of our own future. We have established the first joint co-trustee arrangement on the Aboriginal Housing Foundation in Western Australia for the Noongar people. Once that is finalised, we expect to be providing homes for 150 people, providing support on domestic violence and support on aged care. So it'll be a whole of community solution for the Noongar community just outside of Perth. So we're really proud of the work that we're doing there, and we see great opportunities going forward. The focus for CTS is, it's been a great business and it's going to continue focusing here in Australia on new startup fund managers and global entrants that are coming into Australia. We see increasing use for our services for people who have got internal RE, looking at potentially using our expertise when they look to develop their fund ranges. We wrote 3 new listed investment trusts through the course of the last year. And whilst the government has changed the stamping rules in relation to those, there are other very innovative developments happening on the listed vehicle space in connection with unlisted managed investment schemes, which will widen distribution for funds managers. And we want to be at the forefront of helping fund managers make the most of that development. We're building the structured finance area and the debt area and securitisations. Philip mentioned the progress that's been made there. We're seeing really encouraging wins. We've got a great team set up in Sydney as well as in Melbourne. And then finally, continuing to grow in the UK and Ireland. So I think the blue chip clients that we've been able to bring on in the course of the last 12 months is really going to hold us in good stead as we prove ourselves to those markets. And those markets are starting to free up again. And again, there's an increased focus on great governance and internal fiduciary type roles being externalised in that market. So let me summarise. We've obviously experienced really strong funds under management growth in a very challenging environment. Solid revenue growth. The underlying earnings per share and net profit after tax marginally down, reflecting that market movement. We've kept investing in the business through the course of last year, and it really does give us a foundation for growth. The new appointments that we've had, really give us good momentum going into FY21. Our first month of FY21 has been a very good start. The balance sheet's in great shape, and we believe we're delivering for all of our stakeholders. The industry is going, through significant transformation, and that is providing us opportunities. We'll keep investing in our people and technology to capitalise on those opportunities while they present themselves. We're looking how we grow organically, but also inorganically in this environment. Our strengths, I think, as a respected and specialist capable company are increasingly being recognised by the industry. We expect the benefits of the investments we've made in FY20 to continue to flow into the year ahead. Market volatility will always be an impact on our revenue, given it's so linked to asset values, and that'll continue to influence outcomes through FY21. We can't control that, but we believe we've got an encouraging outlook for FY21 and beyond. So thank you for listening. I'll stop there and happy to take any questions that anyone has. Good morning, Mick and Philip. I refer to slide 9. The revenue margin of the new business based on the disclosure appears to be around 2 basis points. Could you please outline the revenue dynamics for each of the business lines? Secondly, is 2 basis points a fair assumption for new business moving forward? Also, someone's done some quick calculations, which is good. I think, look, each line of business, has a different pricing model. Typically, it is priced in basis points, but in some cases, we have minimum floors put in place, based on the actual resources we put in place to take on an appointment. The prices vary, our fees vary anywhere between low single-digit type basis points like that up to 5, 6, 7 basis points, depending on the type of appointment that we're taking on. Obviously, when large-scale appointments come on that are already established, much of the work is already done, and we're moving into BAU. So it's a different, slightly different type of pricing for existing funds versus ones that are starting from establishment. Philip, do you want to add anything?
Perhaps just to say, Mick, that's a good characterisation on the CTS and the superannuation side. On the obviously the private client side of the business, it's a higher touch business, and the the revenue dynamics there and the basis points are much higher and reflect the trust management workload associated with those. So they can be 50 basis points or 100 basis points or more, depending on the actual services provided.
I've got another question here about the regulators and the relationship that we have with ASIC and APRA. So, look, obviously the regulators have a very tough job to do in these circumstances, and following the Royal Commission, a program has been put in place by both APRA and ASIC, and they're pursuing those actions and initiatives, and we encourage them to do so, and looking forward to changes in terms of the regulation as that unfolds. Well, our relationship with both regulators is really sound. We take an approach of being transparent and being active with the regulators. Obviously, when they're looking at the growth of the business, they need to be taking that into account with us, and we're looking to have a collaborative relationship as much as we can, but obviously we are being regulated by both APRA and ASIC and welcome that. In many cases, we look as if we feel we are standing in the shoes of regulators. So, it's a very important part of the way we operate the business and the governance. So, the course of the last 12 months, I think we've had a good relationship and position in working with them. The next question is, going on from the pricing question, what are you seeing in terms of competition in the market? Is there more pressure on price versus 12 months ago? Look, I think in the private client side of the market, there is some pressure on price because investment market returns are reducing. The interest rates have come back, so that's causing margin compression in different parts of the private client area. In terms of the two corporate lines of business, for superannuation and for corporate trustee services, there hasn't been a lot of change. I think it's a competitive market with multiple players, but the onus on the providers is increasing all the time with the regulation. So, our position is, we would like to maintain the fees where they are, and if we can do that while coping with some of the regulatory change that goes on, that'd be an excellent result for clients. And we have been managing to do that over the course of the last couple of years as there's been significant regulatory change. Comment in the slides, there was a focus on larger scale opportunities as managers consider specialist outsource model. What asset class types of managers are considering outsourcing that have not previously? Good question. For funds managers, really it's an issue of them wanting to focus on their core strengths, delivering investment returns and distributing to clients and keeping their clients. But there's increasing sophistication in vehicle structures. And as that happens, I think many managers are thinking, well, maybe some of that complexity is better done by a specialist, with them being able to focus on their core business. So it's really those managers that are looking to utilise different collective investment vehicle structures going forward. And we see, there's going to be quite a lot of innovation in that front over the course of the next number of years. And that's where we can assist. So they might have had an internal responsible entity position before, but when they think about it that way, come up with a different conclusion as to how they should move forward. Now, the next question is, you obviously had a very big month of July with the two big appointments, but can you comment on how significant the pipeline of new opportunities is at the moment? Well, that is right. It has been a big month in July, and I'm not saying that we can replicate those type of results going forward if you look through the whole course of the last 13 months. But the pipeline is very sound. As I said, the industry transformation that's going on is favouring our model, and we're having plenty of conversations with some larger scale opportunities around their fund governance, both for superannuation and on the investment front. I'm not sure there's any other.
One more question there, Mick.
Oh, sorry, my apologies. Can you be cost competitive versus the internal option for these fund managers, considering outsourcing? Is this more driven by governance? That's an excellent question. The reality is we can be more cost effective, but that really isn't the pitch. The pitch is get the best governance model in place for your investors and your clients and your members, and reduce your risk and allow yourself to focus on your core capabilities of investment management or superannuation provision, and securing clients and maintain those clients. So that is how we pitch. It's considerably reduced risk because you're removing the conflicts, you're removing the vertical integration, you're focusing on your own core services. But the reality is, because of our scale, we can actually be more efficient as well. But that's really not the way we would go into a discussion about an outsourcing of our current internal model. It's about our capabilities and delivering a better result for them and for their investors. Well, I think that's the end of the questions. Thank you, everyone, for those. We're at the end of the allotted time, and we will be on the road virtually over the coming weeks, talking to investors. I'm very much looking forward to it and appreciate you joining the webinar this morning. Thank you.